Hey, everybody, welcome back. It's your boy, Chicago Sean McLaughlin. How are you? I hope you had a wonderful 3-day weekend. I certainly did. Go Bills. Big win for my boys. Big win for my hometown team. Looking excited to next weekend against Kansas City. But you're not here to talk football, and I'm not here to talk football either. I'm here to talk options. Options give us options, right? Any of you who follow me on Twitter may have seen a thread I put out over the weekend. I was just kind of brainstorming an idea, and I thought, why not put it out there and get feedback from everybody? And I got some great feedback, so thank you very much. It got me thinking a little bit more deeply about a new strategy. And you know what? Going through that process, kind of opening that can of worms and putting it out there for all to see, I kind of decided maybe that's not the best strategy. I think maybe it requires too much margin, too much open risk potentially, too many cans of worms that could be opened on that strategy, I think. But the exercise of going through that actually took me down another path, and it's not a path haven't been down before. It got me rethinking a strategy that I've employed in the past, a similar strategy I've employed in the past to great success with the SPY options. I don't want to brag. I'm certainly not trying to get anybody excited, but there was one time back in, I think it was 2014, 2015, I had a stretch over 8 months where I traded my account up something like 360 some percent. It was insanity. Now, I got a little ahead of myself doing that strategy, and I didn't manage my risk properly, and I ended up giving a lot of it back. I still finished that year with 100% gain, something like that, but way off my top levels, and I kind of backed away from that. But I going through this process over the weekend, I thought a little bit more about selling premium in SPY options and revisiting that strategy that I had great success with in the past. And I thought of some new ways I might be able to manage it a little better. Might be able to keep the positions on for shorter time frames, so I'm not exposing myself to too much time risk in the market. So put me down a rabbit hole, which is where I'm at right now. I will share my screen with you. I just want to show you the position that I'm in right now. I mean, this is kind of how the P&L curve looks for this position. SPY ended the day around 78.72. 378.72 right here where this green flag is. So as long as the S&P stays kind of in this area over the next couple of days, I should make money. Now, here are all the trades that I did today. And let's kind of bring up a options chain here. Let's do the... No, what am I looking for? I'm looking for the options table. There we go. And so when the market opened this morning, this is the January 19 options, I sold... basically, it calls it an iron condor here on the platform, but basically it was an iron butterfly. I was short the 78 calls and the 78 puts, and I protected it with a 76 put on the downside and this 380 call on the upside. And I brought in $1.35 credit for that. And the thinking was, as the market moves throughout the day, if any one of these short options, again, short the 78 strikes in both the calls and the puts, if any one of those go in the money by $1 or more, I will roll them out to the next expiration series for a credit. Well, lo and behold, it happened on both. Later on in the morning, you can see the trade right here. This is about 2 hours into the trading day. The market was selling off, and I closed my 378 put and rolled it to the next expiration, which is tomorrow, January 20th. I rolled it out to the 377 put right here. Okay, and I did that for a credit, 42-cent credit. I did the same thing on the call side later on right here when the 78 calls in January 19th went in the money. I was short these. I rolled those out $1 up to the 379 strike next week out, or next expiration out, and I brought in a 26-cent credit there. So what I'm trying to do is whenever any of my short options go in the money, I want to roll them out for a credit. Now, in this case, I only had to roll them out one expiration cycle, which in this case was 1 day. But had I not been able to get a credit rolling up one strike in that series, I would have looked to the January 22 options, or maybe even the January 25. Hopefully I wouldn't have to go that far. But all the while, at least intraday, as I roll those short options out, while it will require margin to hold those short positions because the brokerage thinks that you're holding a naked option because there's no other long option on that series, I am theoretically, at least intraday, protected because I had the long call here that expired today. I also had a long put which expired today. I closed it right at the end of the day for $1. Why not? I was able to get a penny for it when the market was closing. Sold it. You can see it. You can see it right there. But none of these short options were unprotected. Now, once we were getting into the end of the day, I did have to make a trade, which I did right here. I bought a strangle. I bought the 25 delta put right here, and then the 25 delta call right here at the end of the day. I paid $1 for it. So that I did not have any open-ended risk. So I end the day basically, and again, I'm doing this with one lots, guys. We're just experimenting, trying things out, not trying to blow the doors out anywhere. But right now, this position will require $400 in margin, right? I got 2 short options here and 2 long options there, $400. I only have $200 of exposure on the call side, so it's really just the put side that matters. So $400 margin requirement to hold this trade overnight. But the important thing is that if I go to see all the trades, this is all the trades I did in entirety today, you'll see I brought in $175 in credit minus my commission and fee. So let's call it $163. I brought in $163 of credit today. Now, guys and girls, what I'm planning on doing going forward is trying to be cash flow positive every day. I'm not so worried about my P&L. I did end up the day a very small P&L, $11 right here. But if I'm cash flow positive every day with defined risk, then over time, this money will compound. Ultimately, what I want to happen in a perfect world is I want all of these options that I'm holding to expire worthless, both the short calls and puts and the long calls and puts. I want them all to expire worthless, because if they expire worthless, then I keep the cash flows. And that's really what I'm trying to do here, is just make money on cash flows. That's it. And trading one lots, if I could be cash flow positive $100 every day trading one lots, that is successful to me. I'm not risking a whole lot here. Like I said, right now, my max margin here is $400. I've already brought in, what do we say, 163? So 163 minus 400, the most I could lose here is $275, right? If we have a huge gap down tomorrow, the most I could lose is $275. But even if we do have a huge gap down tomorrow, I'm going to roll these puts out, these short puts out for a credit. I will do that. And then I will make sure that I end the day with those options being hedged. I'll cover them with 25 delta options in that same series. But again, the thinking is I want to be cash flow positive. I also want to keep my deltas approximately neutral too. Now, you're noticing I have 2 spreads here on the put side and only 1 on the call side. That is because as the market was rising today, you can see here, this is the S&P was rising throughout the day. As the market was rising, my delta was getting a little bit negative. Okay, I got about 25 deltas negative, and 25 deltas is where I want to make an adjustment. So what I did is I added another put spread right here. I sold the 78 put and bought the 75. So I sold this 78 put right here, and I bought this 75 put right there, and I collected 71 cents for it. And when I put that trade on, that neutralized my deltas. That brought my deltas right back to about 0. Now the market has since moved again, and I'm sitting on a positive 10 delta, which is great. Right now, trading one lots with this strategy, I want to be inside plus or minus 25 deltas. Because when I'm putting on these spreads, I'm selling the approximately at the money option, and I'm hedging with the 25 delta option. So that's going to give me, if I'm selling a put, that'll give me positive 25 deltas. If I'm selling a call, it'll get me negative 25 deltas. So that's why I have a little imbalance here, because I was hedging my risk as the market was going up. All right, well, I hope that that wasn't too complicated there. We'll get better at that. We'll get better at the explaining. And as we go along, I'm going to make the adjustments every day, and I'll show you what I did. And I would love to have your feedback on it. So this strategy is all about collecting premium. It's all about being cash flow positive every trading day. That's all I care about. The P&L will take care of itself. At least it should. As long as I'm positive P&L every day and my options are expiring away worthless, that's the goal. I'm going to win in the end. Is this going to be a massive home run strategy? I don't know. I don't think so. I mean, it could be, but I don't want to take too much risk to make it a home run strategy. But can it be consistent? Can it make a few $100 a week just trading one lots? I think so. I think so, without taking too much risk. So hope that was instructional to you guys. Check out the other videos in the YouTube stream if you want. This is all a work in progress. I don't think any of the videos are all that great. I'm getting better with this technology as we go along. But subscribe to the channel if you want to keep up to date with what's going on here. It really helps the SEO. It helps more people discover this. And the more people engage with me on Twitter talking about these strategies, we can all learn from it. So have a great evening. Have a good trading day tomorrow. And we'll see you again later. Bye-bye.